T-Mobile is making big moves, expanding, acquiring, and investing heavily. But behind the growth, there's a deeper financial story investors need to understand. Let's break it down. Only on the FinTalk channel.
So, if you look at your monthly cell phone bill, you probably assume you're just paying for a connection to the internet, right? Like a way to make calls and send texts.
Yeah, I mean, it feels like a really simple transaction. You pay for a utility.
Exactly. But according to the financial filings we are looking at today, that monthly payment is actually, it's feeding a massive subprime lending bank.
Right. And a corporate real estate flipping empire.
Yes. And like a rapidly expanding digital billboard agency that just happens to have cell towers.
It really forces you to completely redefine what a modern telecommunications company actually does behind closed doors. Because, the public-facing brand is all about 5G speeds and phone upgrades.
Right, the commercials with the celebrities.
Exactly. But the underlying machinery is entirely focused on complex financial engineering and, well, data monetization.
Okay, let's unpack this. For today's custom-tailored deep dive, we are taking a magnifying glass to T-Mobile US Inc.'s Q1 2026 financial report.
And specifically, we're looking at their Form 10-Q for the quarter ending March 31st, 2026.
Right, which is basically the raw, unfiltered diary of a corporate giant. The mission here is to decode these dense legal and financial disclosures to reveal how a modern cell carrier actually makes its money, like how they fund their growth and handle these, frankly, staggering hidden liabilities.
And the top-line numbers in this document immediately signal that something highly unusual is happening right now.
A huge divergence because T-Mobile pulled in an astonishing $23.1 billion in revenue in just the first 3 months of 2026.
Which is massive.
It is. That's a significant jump from the $20.8 billion they made in the same quarter of 2025. So they are pulling in vastly more cash from customers. But their net income, their actual profit, dropped down to $2.5 billion.
Yeah.
They brought in billions more, but their profit shrank. What does that tell us?
Well, you usually expect revenue and profit to move in the same general direction. So when you see a company aggressively growing its top-line revenue while its bottom-line profit actively shrinks, it almost always points to a massive capital deployment phase.
Meaning they're spending it all.
Exactly. They are spending aggressively to fundamentally reshape their corporate identity. I mean, they aren't just maintaining a network anymore. They're buying their way into a completely different future.
And we can actually track exactly where that money is going by looking at their recent shopping spree. And it is a massive spree. Let's look at the telecom buyouts first.
Okay.
The filings detail the $4.4 billion acquisition of U.S. Cellular's wireless operations, which closed back in August 2025.
Right, which is a textbook consolidation play.
Right.
They essentially absorbed a major regional competitor to bolster their national footprint.
Make the map look bigger.
Yeah, pretty much. And they financed a significant chunk of it by assuming up to $2.0 billion in debt. They swapped out U.S. Cellular's senior notes for new T-Mobile notes just to make the math work.
Okay, so that's standard telecom stuff. But then we have the completion of the Kina Corporation buyout.
Yes.
That's the parent company of Mint Mobile.
Yeah.
And this deal has a detail buried in the 10-Q that really caught my eye. So the original acquisition agreement had an earnout structure. For anyone unfamiliar, an earnout usually means the sellers only get the final chunk of their payout if the company hits specific performance metrics over a few years.
Right. Exactly. It keeps the original founders motivated to keep growing the company after they sell it.
Right. But in mid-2025, T-Mobile completely amended the agreement. They basically dropped all the performance indicators and just agreed to pay out the remaining $420 million earnout with absolutely no strings attached.
Which is wild because releasing a performance requirement of that size is highly unusual.
Yeah, why do it?
Well, acquiring companies typically hold on to those metrics really tightly to mitigate the risk of the asset underperforming. But dropping it suggests a desire for immediate, absolute control.
How so?
Well, maintaining an earnout requires keeping the acquired company's accounting somewhat siloed.
Yeah.
You have to track those specific performance metrics.
Oh, I see. You have to keep their books separate to prove they hit the goals.
Precisely. By paying out the $420 million early, T-Mobile removes that administrative burden. They can instantly dissolve the boundaries, merge the data sets, and fold those Mint Mobile subscribers directly into their core machinery.
No lingering contractual friction from the previous owners.
Right. They want total control of the data, and they want it immediately.
And that leads us to the most surprising part of this shopping spree. Because the next two massive acquisitions have absolutely nothing to do with cell towers or phone plans or wireless
This
subscribers.
is where it shifts.
Yeah. In early 2025, T-Mobile bought a company called Vistar Media for $621 million. Now, Vistar specializes in what they call digital out-of-home advertising.
Right.
We are talking about the software that runs digital billboards on the highway, screens in elevators, displays in shopping malls. And then a month later, they dropped another $180 million on a company called Bliss, which provides location-based digital advertising solutions. Here's where it gets really interesting. If you are a wildly successful wireless carrier, why are you spending almost $800 million on digital billboard and ad tech companies? Like, are they a phone company or an ad agency?
If we connect this to the bigger picture, you have to look at the saturation of the smartphone market. Almost every single person who wants a smartphone already has one.
Right, the market is totally tapped out.
Exactly. The pipeline of communication is built. But telecom companies are realizing that owning the pipeline is no longer the most lucrative part of the business model.
Okay, so what is?
The real value is monetizing the eyeballs looking at the devices, and more importantly, the physical bodies carrying those devices around.
Oh, wow. So they are transitioning from being the delivery driver to being the retailer.
Precisely. By moving heavily into ad tech and digital out-of-home advertising, T-Mobile is positioning itself as the platform that actually serves the advertisements, using the hyper-accurate location data their pipeline provides.
That is wild. They are no longer just the invisible wave carrying your text messages. They are the advertising agency tracking where you walk.
Yes.
But, okay, to push all those high-resolution digital billboard ads and to handle the data from millions of newly acquired U.S. Cellular and Mint Mobile subscribers, you need an immense amount of capacity. You need physical and invisible infrastructure.
Absolutely.
And the 10Q reveals they are playing this incredibly complex game of musical chairs with their real estate to make this happen.
Right, so let's start with the invisible infrastructure. That's the spectrum. These are the radio frequencies that carry wireless data through the air.
I used to think of spectrum as like an invisible highway, but after reading these filings, it feels much more like zoning rights for the sky.
That's a great way to put it.
Because some frequencies penetrate concrete walls easily, right? Like prime commercial real estate in a city center. While other frequencies carry massive amounts of data but only travel short distances, like dense urban zoning.
Exactly. And T-Mobile is trading these invisible zoning rights for billions.
Yeah, the filings show a massive transaction with Comcast, where T-Mobile is purchasing 600 megahertz spectrum for up to $3.4 billion.
And they are moving so aggressively on this that they are targeting a $45 million accelerated close in 2026 just to get access to parts of it sooner.
They want it yesterday.
Yep.
But at the exact same time they are buying that 600 megahertz spectrum, they are selling their 800 megahertz spectrum to an affiliate of Grain Management for $2.9 billion.
Right.
And they are selling it at such a massive premium that it triggers an $850 million tax bill upon closing. I mean, they are literally taking an $850 million tax hit just to swap one type of invisible wave for another. Why do that?
It reveals their long-term architectural strategy. Lower frequency spectrum, like the 600 megahertz they're buying from Comcast, travels further and penetrates buildings better.
So it's more reliable.
Yes. It is the foundational layer for a broad, reliable 5G network. They are shedding the 800 megahertz frequencies they deem redundant, and they're just swallowing the massive tax penalty because the 600 megahertz band aligns perfectly with their capacity needs for this new data-heavy, advertising-driven future.
Okay, so that covers the invisible zoning rights in the sky. But you still need physical metal poles to broadcast those frequencies, right? You need cell towers.
You do.
And the disclosures contain a fact that absolutely blew my mind. T-Mobile relies on tens of thousands of cell towers to operate, obviously, but they don't actually own a massive chunk of the physical structures.
They have the tower obligations.
Yeah, the report states they conveyed the rights to operate over 12,000 towers to a company called Crown Castle International through these master prepaid leases. T-Mobile then turns around and leases the space back on those very same towers.
Yeah.
And they carry $3.49 billion in tower obligations debt on their balance sheet.
It is a masterclass in balance sheet engineering. It's known as a sale-leaseback arrangement.
I'm really trying to wrap my head around the logic here, because to me it sounds like selling your house to a corporate landlord, immediately renting your old bedroom back from them, but somehow still being on the hook to pay the property taxes.
That's a pretty accurate analogy, actually.
So why would a company intentionally choose this incredibly convoluted structure instead of just owning the metal poles outright?
It comes down to the velocity of capital. You see, towers are static, depreciating assets, and they are incredibly expensive to build, maintain, and upgrade.
Okay.
By executing this arrangement with Crown Castle, T-Mobile treats these 12,000 towers as financing obligations rather than owned assets. This mechanism provides them with a massive, immediate injection of upfront cash.
Ah, so they're trading long-term ownership for immediate liquidity.
Exactly that. They take that billions in upfront cash and deploy it where the return on investment is drastically higher.
Like buying up U.S. Cellular.
Yes, or acquiring ad tech firms like Vistar and bidding on that crucial 600 megahertz spectrum. They have calculated that owning the customer relationship, the location data, and the invisible frequencies is infinitely more valuable than owning the physical steel sitting in a field.
That makes so much sense. Okay, so buying competitors, acquiring ad agencies, dropping billions on spectrum, swallowing $850 million tax bills. The capital required for this corporate metamorphosis is just staggering.
It's immense.
Where does all this cash continually come from? Well, the source material reveals that a huge chunk of it comes from us. T-Mobile has essentially turned itself into a massive consumer bank.
The mechanism they use is the Equipment Installment Plan, or EIP.
Right. Think about the last time you walked into a store to upgrade your smartphone. You probably didn't drop $1,000 in cash on the counter. You signed a contract to pay it off over 24 months.
Which is very standard now.
But by doing that, you essentially took out a loan from T-Mobile. The 10Q shows they currently hold $7.48 billion in net EIP receivables. I mean, they are managing a multi-billion-dollar loan portfolio.
And they are rigorously analyzing the risk of that portfolio. The disclosures explicitly state they use proprietary credit scoring to divide their customer base into specific risk categories.
Yeah, the sources outline two main buckets, prime and subprime. They are actively grading your credit. And when you average out the financing across these plans, T-Mobile is charging a combined weighted average effective interest rate of over 10.4% on these phone loans.
Which generates a massive revenue stream.
Huge. But here's the most fascinating financial maneuver in the entire report. T-Mobile doesn't actually want to wait 24 months for you to slowly pay off that 10.4% loan.
What's fascinating here is they utilize a financial process called securitization to accelerate that cash flow.
Yes. The 10Q details the use of these structures called variable interest entities, specifically referring to them as bankruptcy remote entities. If I'm reading this correctly, T-Mobile takes your specific phone loan, bundles it together with thousands of other customers' phone loans, and literally sells that giant package of debt off to third-party investors in order to get cash today.
Your reading is perfectly accurate, and the customer has absolutely no idea this transaction has occurred.
Because my bill doesn't change.
Right. You still receive your monthly bill from T-Mobile, and you still send your payment to T-Mobile because they retain the rights to service the account. But the actual debt, like the underlying asset, is now owned by a third party.
That is wild. But why use a bankruptcy remote entity? What does that actually mean?
It acts as a legal firewall. When investors buy this bundled debt, they want to guarantee that if T-Mobile were to suddenly go bankrupt, T-Mobile's creditors couldn't try to seize those phone loans to pay off corporate debts.
Oh, I see.
Yeah, by placing the loans in a bankruptcy remote entity, the assets are legally isolated. The investors are protected, which makes the bundled debt much more attractive to buy.
And it works. The filings show T-Mobile netted $1.35 billion in upfront cash proceeds just by selling off these future customer payments.
It's highly effective.
But I have to look at the systemic risk here because, I mean, what does this all mean for you, the listener? They have a massive portfolio of customers, many categorized internally as subprime, paying 10.4% interest on a depreciating piece of consumer electronics.
Right.
What happens if there is an economic downturn? If thousands of subprime customers default on their phone loans, doesn't this entire securitized structure collapse?
The risk of mass default is definitely a core vulnerability of this model, and the financial disclosures are legally required to address it. T-Mobile quantifies this risk through a $1.18 billion allowance for credit losses.
So they have mathematically projected the likelihood of customers failing to pay and set aside that billion-dollar buffer?
Exactly. Furthermore, when T-Mobile sells these bundled loans to third parties, they often provide recourse guarantees.
Meaning T-Mobile promises to eat the loss if the loans go bad.
Up to a certain predefined threshold, yes. If a specific percentage of those bundled loans default, T-Mobile is contractually obligated to absorb those losses to protect the third-party investors.
Got it.
So the risk of subprime defaults doesn't magically disappear when the debt is sold. It is heavily managed, quantified, and priced into the entire corporate structure.
Okay, so we're looking at a machine operating at an incomprehensible speed. They are a telecommunications network, a subprime consumer bank, a real estate flipper, and a digital advertising agency.
All at once.
But operating a conglomerate this complex creates severe friction. And the final sections of the 10Q expose the brutal human and legal hangover of this massive corporate expansion.
Mergers and acquisitions are often celebrated in press releases as synergy. But the operational reality detailed in the financial filings is usually defined by aggressive reduction.
The reality is layoffs. In the first quarter of 2026 alone, T-Mobile spent $141 million on an initiative they officially call a workforce transformation.
It's a very corporate term.
Very. And to date, that specific program has cost $531 million. That is $500 million spent entirely on severance packages, breaking leases on office space, and eliminating redundant human roles after these massive mergers.
And on top of that, they spent another $85 million restructuring U.S. Cellular immediately after buying it.
Right.
They also detail a $65 million expenditure on a network restructuring initiative.
And the mechanism behind that network restructuring is wild. The report says they use customer-driven coverage insights to identify and shut down low-value cell sites.
Right.
If we break that down, they are actively tracking the ping data from customer phones. They know exactly how many devices are connecting to every single tower. If a specific tower in a rural area or like an overlapping suburban zone isn't pulling its weight financially based on that user data, they just flip the switch, decommission the equipment, and shut the tower down.
It is the definition of ruthless efficiency. Because when you merge networks with a company like Sprint or U.S. Cellular, you inevitably inherit overlapping infrastructure.
You end up with two towers right next to each other.
Exactly. Decommissioning those redundant towers, paying the early termination fees to landlords, and physically removing the antennas costs tens of millions up front. But it eliminates the ongoing operational expense, saving the company hundreds of millions in the long run.
So the human workforce and the physical network are being aggressively trimmed. And then you have the legal ghosts haunting the balance sheet.
Yes, the contingencies.
The FCC is still actively pursuing fines against T-Mobile over privacy violations that date all the way back to the Sprint merger. T-Mobile is fighting the government tooth and nail, pushing the appeal all the way to the Supreme Court. Plus, the report coldly outlines the devastating cyber attacks they've endured.
And the scale of those data vulnerabilities is really notable, especially given their pivot toward data-heavy advertising.
Yeah, the 10Q mentions the 2021 breach that cost them $350 million to settle. And then they detail the January 2023 API hack that exposed the data of 37 million individual accounts.
37 million.
An API is essentially the software bridge that allows an app on your phone to talk to the company's internal database. Think of it like a waiter taking your order to the kitchen. If a hacker finds a vulnerability in the waiter, they can walk out with the entire restaurant's data. 37 million accounts compromised.
When you look at the workforce reductions, the network shutdowns, the FCC battles, and the nine-figure data breach settlements, you have to connect those dots to the ultimate corporate goal revealed in the filings,
Which is
stockholder returns.
And this brings us to the most staggering number in the entire document, because while they are shutting down cell towers based on ping data, navigating the fallout of 37 million exposed accounts, and spending $141 million a quarter to lay off their workforce, T-Mobile's board authorized an $18.2 billion stockholder return program in April 2026.
$18.2 billion.
In the first quarter alone, they deployed $4.9 billion on stock buybacks and paid out $1.1 billion in dividends. How does a company manage to balance massive consumer data failures and network shutdowns with rewarding shareholders so aggressively?
Well, from a purely financial perspective, the liabilities, whether they are $350 million data breach settlements or potential FCC fines, are simply categorized as the cost of doing business.
Just a line item.
Exactly. They are factored into the quarterly models alongside the electric bill. As long as the cash generated from the core subscriber business, plus the billions generated from securitizing phone loans and flipping tower leases, vastly outpaces the cost of those legal liabilities, the machine functions perfectly.
Wow.
The efficiency measures fund the stock buybacks, and the shareholders are rewarded.
It fundamentally changes how you view that carrier logo on the top corner of your screen.
It really does.
To summarize the journey we've been on today, we started out looking at a seemingly straightforward wireless carrier, but by reading the fine print of their 10Q, we uncovered a wildly complex financial apparatus.
A completely different company than what's on the billboard.
Right. They are trading invisible zoning rights in the sky for billions, acting as a subprime lender, charging over 10% interest for consumer electronics, acquiring digital billboard agencies, and relentlessly restructuring their human workforce to fuel an $18.2 billion stock buyback machine.
It leaves us with a critical concept to consider as this business model evolves.
Let's hear it.
We discuss how T-Mobile acquired Vistar and Bliss to dominate digital out-of-home advertising. We also detailed how they use proprietary credit scoring to grade your financial health and how they use hyper-specific customer-driven coverage insights to know exactly which tower your device is pinging at any given moment.
Which is an incredible amount of behavioral data.
Right. So as T-Mobile continues to fuse its vast, hyper-precise cellular network with its newly acquired ad tech empire, what happens when the conglomerate that knows your exact credit score, knows your historical browsing habits, and tracks your precise physical location block by block, decides to optimize the digital billboards and screens in your city specifically around you as you walk past them?
The machine isn't just facilitating your connection anymore. It is anticipating your next transaction. Thank you for joining us on this deep dive. Keep questioning the fine print, and we'll catch you next time.